You're listening to Pre-Market Prep. I'm Brianna Valesky with my co-host Joel Alcana, and we're joined by Michael Hewson. He's the Chief Market Analyst at CMC Markets. Michael has more than 20 years worth of experience trading the markets. He specializes in technical analysis, and his background is in foreign exchange trading. Michael, thank you for joining us on the show today.
Good morning, Brianna. Good morning, Joel.
So we had some non-farm payroll numbers last week, and you were mentioning that you kind of had a contrary view to about the possibility of a September rate rise. Can you expand on that for our audience?
Yeah, absolutely. I mean, on the face of it, the numbers were fairly good. You look at the headline unemployment rate, 5.3%, 215,000 new jobs, and 14,000 revisions higher to previous months. But that's not looking at the whole picture. Look at the participation rate. It's a 38-year low. If you actually look at what the US consumer has done this year so far in the context of core durable goods, retail sales, that remains very, very weak. And that's before you even start talking about the lack of inflation. Everyone knows the Fed has a dual mandate. Now, and inflation is part of that mandate. Now, given Mr. Lockhart's comments last week, everyone seems to have got it in their head that the Fed is going to go in September. Well, that ignores one very significant fact. There's no inflation. The US dollar is up 20% on a trade-weighted basis over the last 12 months. And the fact of the matter is, commodity prices have been on the slide for the past 2 to 3 years and are essentially multi-month and in some cases multi-year lows. You look at the Reuters CRB index, lowest level since 2003. You look at the Bloomberg Commodity Price Index, similar sort of story. And the fact of the matter is, guys, you look at the rig count on Friday, they ticked up, which suggests that despite the massive cut in rig counts, oil production still remains at very, very high levels and demand continues to remain weak. Against that backdrop, I fail to see how anyone can conclude that the Fed will raise rates next month.
So you also mentioned that there was some Chinese data that was disappointing that also added into your point that you don't see, we won't see that rate rise.
Yeah, absolutely. I mean, you look at the Chinese economy, its import and export data has been very, very poor pretty much every single month since February. Exports were down again, 8.3%, and imports were down as well, 8.1%. And I think, again, that feeds in to the lack of, or a slowdown, in growth in the Chinese economy. Now, you may argue that it feeds into a wider narrative that the Chinese authorities will do more in the context of stimulus measures. Well, they've already loosened monetary policy 4 times since November last year. But I look at those factory gate numbers, lowest level since 2009, a decline of 5.4%. The fact of the matter is the deflationary effects that have been affecting China have been rippling out into the rest of the global economy. And you look at the slowdown in Chinese exports to the euro area slid 12.3% last month, 12.1% to Japan, and even the US, we saw a decline in Chinese exports of over 1%.
Well, so if not September, then when? Do you think we can still even expect a rate rise this year?
Well, that's indeed the big question. I mean, I suppose if you were to listen to Mr. Lockhart, then if you don't go in September, when will you go? And that's a very valid question. But the fact of the matter is, do you really want to run the risk of tipping the US economy back into recession when there is no evidence of inflation? The fact of the matter is the dollar is 20% higher. If you raise the Fed funds rate even by 25 basis points, the markets will then inevitably focus on when the next rate rise comes along and potentially could push the dollar even higher. I really don't see what the problem is or what the urge is to actually raise now. I think, if anything, the Fed missed their opportunity to raise rates a year ago. You look at the growth forecasts that the Fed have put out every single meeting, quarterly meeting. Each meeting, they've downgraded their growth forecasts or their inflation forecasts. Against that backdrop, why would you raise interest rates? I just don't see how you can do that.
Are we stuck here? Is our economy addicted to low interest rates?
I think that was always going to be the problem. I think once you embark on the sort of quantitative easing measures that most central banks have done is how do you exit that strategy? I think interest rates are a very, very blunt tool to actually deal with a much larger problem. I would suggest that they would start actually not reinvesting the proceeds of the asset purchase program first and foremost before they start looking at headline rates. Because when we went into the crisis, what was the first thing central banks did? They cut rates. Then they did QE. Well, surely it then makes sense, now that they've tapered the QE, is to stop reinvesting the proceeds and actually start shrinking the balance sheet before you start raising interest rates. And to be quite honest, to some extent, I think the Fed funds rate is largely irrelevant in the context of sort of consumer borrowing, because how many people actually pay that low level of interest rate on their mortgages or on their personal loans? They don't. The market sets the interest rates. If you look at US bond yields, they've actually been tracking lower since that June meeting. Certainly on the 5 and 10 year, they've been tracking lower, even though the 2 year is pushing up towards its highest levels. And that suggests to me that we're on a much lower growth path and a much lower inflation path, if you're to believe what the bond markets are telling you.
How are other monetary institutions handling this situation? Bank of England last week kind of signaled that it's going to remain on course to start gently raising interest rates in the UK early next year. How are other, institutions dealing with this?
Well, I think in terms of what the Fed does, I think the Bank of England actually holds some very salutary lessons, because I think if you look at the UK economy and you look at the US economy, generally they've been following fairly similar paths in terms of their growth trajectory, and in terms of their unemployment rate. Now, some of the demographics are potentially slightly different. We're showing record participation in terms of the workforce, whereas the US is showing worryingly weak participation. And I think that's where you've got a little bit of divergence. But the fact of the matter is, policymakers here in the UK are worried about what's going on with respect to global inflation. And I think that's why they're being very, very cautious about the glide path for interest rates. Now, I think with respect to Mr. Lockhart, his equivalent in the UK is Mr. McCafferty, who actually voted for a rate rise at the last meeting. Dissent is nothing unusual on the Monetary Policy Committee here in the UK, and I think the likely outcome of the Fed meeting in September is you could see a split. You could see dissent on the part of Mr. Lockhart, who says basically the bar is very, very high for not raising rates, but I have a feeling that he will find it much harder to persuade his colleagues. Certainly Stanley Fischer on Bloomberg this morning appeared to suggest that very thing. No rate hike until the Fed sees inflation returning to normal. I see no evidence of that at the moment.
Michael, moving on here, it just seems just like a couple weeks ago, the market was just all worried about Greece and, now, you do have a temporary deal in place. Do you just see this just, kind of just being swept under the table again? Unless they truly...
I do.
Yeah, okay. Go ahead.
I do. You look at Greece's debt pile, Joe, and I don't think anyone with any ounce of sense really thinks that it's sustainable in any way, shape or form. The austerity measures that are being asked to implement, while necessary on the one hand, won't go in any way to help them to basically grow their economy. And that's notwithstanding, obviously, the political problems that Mr. Tsipras, the Greek Prime Minister, has to encounter in terms of holding his party together. The fact of the matter is, there's also the fact that 86 billion euros may well not be enough given the performance of the Greek banks. The Greek banks need recapitalising from the ground up. They need a whole host of bad loans to be either put in a bad bank or written off. And then you've got the disagreements between the IMF about debt write-downs and obviously Germany's position, where they don't want to countenance any sort of debt forgiveness. Well, unfortunately, I think in the case, you've got a similar case in the context of Puerto Rico. Unless you put some form of Marshall Plan or recovery plan in place, simple austerity isn't going to do it. You look at the metrics of the Greek economy and that PMI number that we saw last month, a PMI number of 30 for July. that is just a horrific number, which suggests to me that the financials for an 86 billion euro bailout are no longer apply. You're probably looking at a much higher level of help that the Greek economy needs to get itself back on its feet. And that's before you even start talking about the structural reforms in its public sector, as well as in reforming its institutions so they actually collect the right amount of tax revenues.
Moving on here, Barron's over the weekend. I know you talked about oil a little bit. Time to buy commodities here. And I know you talked a little bit about oil here and the effect from interest rates. I mean,
Catch
gold.
a falling knife, Joel.
Okay, all right, go ahead. I agree with you.
I take your point. I mean, we are at we're at multi-month lows. Certainly, if you look at WTI prices, you sort of ask yourself, how much lower can it go? We're certainly not anywhere near the lows that we saw in March, where we found support around about $42 a barrel. But I think for me, the direction of travel, I think, remains pretty clear in the context of, unless someone decides that they're going to cut production, then essentially prices are completely beholden to supply and demand. And I think the strong dollar is going to have a play a part in that. And if the Fed does decide to hike in September, and I still maintain that's unlikely, oil prices and commodity prices are going to remain under pressure. And it's not just oil prices. If you look at sugar prices, if you look at corn and wheat prices, they've also been in a downtrend for the past 2 or 3 years. I can't think of one single commodity, perhaps apart from coffee, that's actually higher now than it was 12 to 18 months ago.
Okay. Also, just a general market question here. I mean, you had your sell-off in Apple. Obviously, the commodity-related stocks are, not looking the greatest on the charts besides dividend. Biotechs, you get a big bang for your buck, but sometimes the other way. If someone has some new money to put to work in the market, what sectors, or do you have any individual issues that they should perhaps be evaluating?
Well, obviously, valuation, I think, is key for me. And I was looking at the S&P 500 this morning, actually, and I was comparing the virtues of two completely different tech stocks, but both of which have done very, very well in, say, for the past 2 or 3 years. On the one hand, you've got Netflix, whose growth has been absolutely parabolic in terms of its share price over the last 6 to 8 months. And then you look at Apple, which generally everyone seems to like, but at the moment people are a little bit concerned about. Then I look at the price earnings forecasts going forward for Apple, and then I look at Netflix. And I have to say, Netflix terrifies me, because I look at the forward valuation on that, and it's trading at 450 times forward earnings. And then I look at Apple, and it's trading on a 14. Well, I'll give you a clue. I know which one I'd buy, and it's certainly not Netflix. I think Netflix is in bubble territory. Basically, Netflix is trading on the basis that is going to blow all of its competitors into the weeds, and I just do not see that happening. I think Netflix is a bubble waiting to burst.
Do you try and play it at all from the short side, either the stock or puts, or do you just?
I'd probably play it from an option. I certainly wouldn't try and play it from the short side, because that's a pretty dangerous strategy to play. But I'd certainly play it from an option. I'd play it from an option side.
Yeah, I have a few times, and I look at the chart and I'm like, oh my gosh, how did I ever squeak out a profit in that? But a lot of it is timing.
It is, absolutely. I mean, that's the problem. It's like trying to catch a falling knife, or it's trying to pick the top in any particular market. So many people go broke in doing that. But I look at Netflix, and it looks as if it's on the brink of potentially exhausting itself. But again, as you say, timing's a big thing. I look at Apple, and I think we could probably come back to around about $100. Probably pick some up there. Perhaps there's a nice uptrend line in place from the lows of 2013. If it breaks below $100, I'd sort of reassess it. But overall, I think if you look at Apple and you look at Netflix, Apple is a much better long-term play.
Okay, yeah, just looking. You've had three lows here in the 121, 122 area in Netflix. Trading above that level. I'm going to mark that down on my pad and maybe see if it takes out that level because I don't see much until 113. Michael, just before we let you go here, I know you're also involved in trader education, delivering education support functions to diverse audience from experienced traders and private investors to corporate and retail clients. Could you just, give us a little bit of a background and what kind of services you offer, and if people are interested, how they can access it?
Well, generally, I mean, the company I work for, we're a CFD brokerage, contracts for difference, and my primary role is to make sure that our clients go into a trade with their eyes open. They manage their risk properly, and ultimately they have a trading plan. But also, it's all about looking at the market and looking at the different factors that can affect markets. So, for example, interest rate differentials. You look at the bond market. You look at correlations between bond markets and FX markets. You look at correlations between the FX market and the dollar index. You look at correlations between the Australian dollar and potentially commodity prices and the mining stocks. I'm basically trying to lattice all that knowledge together in a very simple trading plan. And I generally tend to work off, as you just said there, support and resistance levels, trying to keep it as simple as possible, but also be aware of all the different factors that drive the markets as well. So not only be aware about the technical, where the technical levels are, but also what different macro factors will affect those particular chart points and those particular levels. Hopefully that gives you some sort of indication as to the way that I try and pitch our services to our clients.
Thank you very much, Michael. Michael Hewson, Chief Market Analyst at CMC Markets. Thanks for coming on, Michael. We'll talk to you again soon.
Cheers. Thank you, Joel.